Okay, well, hello, everybody. This is going to be our video for Chapter 18 in this course, dealing with corporations, partnerships, states, and trusts. And primarily what we're going to be talking about here is corporate organization and also a bit about capital structure, but mostly about organization and primarily about a lot of content dealing with what's known as Section 351, which is a code section in the Internal Revenue Code that's maybe not familiar to a number of people. It tends to be associated really primarily with startups, but as we'll see, it doesn't have to involve a startup. But it's simply a way for people who invest in companies to transfer basis in property over to the company in which they are investing. And it allows them to defer taxation, and that's a good thing. And so we're going to talk a bit about that and how that works. And so let's talk a little bit about what we're going to be covering in this particular module. We'll talk about the tax consequences of incorporation, and in particular, the idea of what happens when people start a business and issues concerning debt versus equity, and that's coming up a bit later. And we'll talk about this issue of basis and the transferring of basis primarily from shareholders to the corporations when those shareholders are donating or not donating, contributing property in exchange for stock in the company, how that whole transaction is handled, and what the tax implications are, not just the accounting and business ramifications. And we'll talk about what happens when corporations assume the liabilities of shareholders. It definitely has a tax consequence, particularly with shareholders themselves, and we'll see why that's the case. We'll talk a bit about capital structure and also particularly this issue of debt versus equity and how sometimes the IRS will recharacterize certain equity investments as debt. Debt investments as equity. And we'll talk about why that is the case, particularly given the tax advantages that might accrue from debt as opposed to equity. Although since the passage of the Tax Cut and Jobs Act, it's not quite as an imperative bit of enforcement. And we'll talk about debt and losses, debt and stock gains losses, and then a little bit about tax planning opportunities. And I know that when we talk about tax planning in general, it's something that we would all like to spend time talking more about. One of the things that I think makes tax interesting, whether it's individual tax or taxation of businesses, is the idea that so many situations are unique in their own right. And again, as I think I mentioned in my prior video, I do have sort of the assumption that most people who take this course are looking to be involved in some kind of practice. I also teach the introductory accounting courses, Principles 1 and Principles 2, that is intro to financial, intro to managerial. And I make no assumption that the students are going to be involved in any kind of accounting practice. Here, I think it makes a little more sense to talk about it, particularly in the sense of how one might advise clients in particular situations, knowing, of course, that situations are unique. And it's no wonder really why financial providers of all kinds, whether they're banks or mutual fund companies or investment firms, will say, with regard to almost any product, consult your tax advisor, just because there's no way they could address every situation or discover all the information that's needed, and nor do they really want to. And so this is why having a qualified tax professional to do one's taxes and also to help do tax planning really is essential, particularly in the business context. I can't think of too many businesses that would benefit from doing where the proprietors would want to do their own taxes, unless perhaps they are themselves tax professionals. And even there, that's not always the case as well. So it does help to have somebody who is very skilled and experienced in a certain area to have a look for you. Okay. All right. So let's talk a bit about corporate issues. And we're going to be talking primarily about formations, meaning businesses starting out. Now, by the way, I know that when we talk about particularly the 351, Section 351 transfers, we're talking about people who are forming a corporation primarily. Now, 351 does not necessarily apply to startups, but I think it's what we mostly think of, particularly because we're trying to have contributed property in exchange for stock. And yes, that can happen sometime down the road, but it is a bit more complicated. And sometimes the IRS will disallow that, particularly if any kind of maneuver years down the road is simply intended to dodge taxes. And what else is new? The IRS has all kinds of enforcement mechanisms where they disallow certain tax treatments because they think all the transaction is to avoid taxes. And we see this as a theme that comes up again and again and again, and we'll see that. So we'll talk about the tax consequences, both for the shareholders and the corporation. We'll talk about what happens when shareholders transfer property to a corporation, and we'll talk about a little bit about the capital structure. Capital structure, I think most of you probably have by now understood the capital structure is simply the combination of debt and equity and the various kinds of debt and equity that are used to finance a business. And this is one of the biggest issues in finance courses, certainly is capital structure, the cost of capital, what the benefits are of the various kinds of capital. It's really hard to say that one is preferable to the other. In fact, a lot of people, I think, would probably view that debt financing may be more practical or more beneficial than is equity financing, although it's really hard to make a blanket statement along those lines. We'll talk about some special tax treatments, particularly with regard to gains and losses that go to the investors, and any kind of special treatment from the disposition of qualified small business stock, which I think you'll find to be very interesting. It refers to code section 1244, and we'll get to that here before we finish. And so let's go on here and talk a bit about section 351. This is something that really relates to how a shareholder or a group of shareholders can receive beneficial tax treatment from contributing property to a company in order to make, particularly appreciated property, that is where the fair market value exceeds the basis. And what happens is typically, if that particular contribution and the contributions of all others that meet what we call a control group, which we'll talk about in a second, meet the qualifications of section 351, any gains, even though the property is changing hands, are not realized and are realized but not recognized. So remember the difference between realized gains and realized losses, for that matter, and recognized gains or losses. Realized gains or losses are simply the accounting difference between a disposition value and the original cost, including acquisition and whatnot. And recognized, though, is simply any kind of tax treatment. And in very many cases, realized gains and losses are the same as recognized gains or losses. It's not always the case, but often it is the situation. But in this case, recognized gains are deferred from a tax standpoint if all these qualifications are met, and we'll talk about those. And the reason for that is there are a number of different reasons. Number one, the economic status of the property itself is not necessarily changed, particularly since the shareholders are actually now owners or part owners of the corporation. And sometimes the property they're contributing is still going to be under the control, physical as well as managerial control of the owners, whether it's real estate, such as buildings and land, or whether it's equipment like trucks and furniture and fixtures and things of that nature. So in that regard, there's no real material change in the operational workings of these productive assets. But also another one it's a very much a practical reason is that oftentimes the shareholders lack the cash to pay a tax on any realized gain. So if we had a recognized gain, they would have to pay tax on it, and oftentimes the cash simply isn't there because they haven't sold it. There's no check they're getting in order to dispose of it. They're simply transferring it from one legal entity to another, and so as a result, there's no recognized gain, so therefore no tax consequence. And it's important to realize also that when we talk about this beneficial tax treatment, we're simply saying that they are transferring title and transferring basis as well, and there's no necessarily cash involved, although we will see cases in which it is involved, but for different sorts of reasons. It's not a sale, it's not really a disposition, it's just a change in the character. This reminds me a little bit of alternative minimum tax treatment. For those of you who may have studied that in tax one, where sometimes people would be granted, I know back in the 90s when we had all these startups in the tech world and people were granted stock options that suddenly became very valuable. But they were locked out from selling their stock, and yet they had a huge tax liability and just simply didn't have the cash to pay. So if you don't have the cash to pay, that's simply a problem. And so the government is well aware that sometimes people cannot pay taxes, and so in this regard, there's a practical reason for that as well. Okay. And also another sort of practical issue, it's more of a public policy issue, is that the choice of the business entity should not be compromised by tax rules. I think that forming a corporation makes a lot of sense. And, we've by now learned about the benefits of forming a corporation as far as, limited liability and all that. And so I think that there's a reason to do that. Plus, if you have a company, particularly a startup, and I know I keep coming back to startups, but tends to be sort of a theme of this particular code section. But if you have a product that's just going to knock it out of the ballpark, and it's going to be a super duper product, or even something that's going to make a wave, and you want to take your company public at some point to sell your shares to the public, well, you've got to do a corporation first in order to do that. And how do you go from one entity to another? And so to ease the formation of a corporation, this code section has been enacted. There are some tricky pieces to this, and so what I would encourage you to do is to take your time in reading through this. Make sure you're familiar with what's being discussed, and I would, sometimes if you get a little bit frustrated, kind of go back a little bit later. You can also consult a lot of other resources as well. You might be a little bit careful. I was kind of, and sometimes I sort of knock on doors of the internet if there's something that I need a bit of a different, idea as to how something is presented. And sometimes the information I get is not always correct. And so I think that's something to be careful of. And so, kind of get a consensus view as to what is going on. Okay, so that's just a bit of a warning there. All right, so let's talk about this idea. What is the transaction? It's very simple. You've got cash or other property. It can be real estate, it can be vehicles, it can be whatever. It can be intellectual property being transferred from shareholders to the corporation. In exchange, corporate stock goes in this direction. This is considered to be an arm's length transaction, meaning that it's a fair transaction. And as a result, you've got the property going this direction, now owned by the corporation. And any realized gain is now not recognized for tax purposes. And the thing to know is that any gain here is only deferred until eventual disposition, presumably by this corporation. So it's not exempted. This is not a tax-free transaction. It's just a tax-exempt or tax-deferred situation. However, having said that, it could be many, many, many years before the assets in question are disposed of, and they could easily outlive the life of the shareholders themselves who are making the transfer. So there's no limit as to how long those can remain under that sort of deferred status. Now let's talk about a control group. So when we're talking about a control group, we're talking about a group of owners who have to control at least 80%. That's 80% or greater of the corporation after the transfer. Okay, and this is important because if this condition is not met, the benefits of 351 are not applicable to them. And there are a few rules. They're not all that complicated, and a good tax accountant can certainly ease the process, as well as a tax attorney or most attorneys. But I think that care should be taken to make sure that there's no slip up, particularly if you are looking to benefit from this tax deferred nature of this. Okay, so when we talk about what's going on here, let me see what we got. This is the example we've got of a formation. Okay, so this is just one particular example that we should be looking at here. And in this case, you've got the tax basis and fair market value, which again do not have to be the same thing. In fact, when we talk about 351, we're oftentimes talking about appreciated property, and obviously cash fair market value is very simple there. But furniture and fixtures, $20,000 basis, which tends to be based on historical cost. Fair market value can be whatever it is. That's sometimes not always the case. You're going to have furniture appreciate, but let's just go with the example. Land and buildings, definite appreciation possibility. So the tax basis of the property that's being contributed is 270. Fair market value is 370,000. As a result, because the exchange involves an exchange of value, fair market value for fair market value, 370,000 in stock is transferred in this case to the owner. So remember, it's an even trade, back and forth. And without this, though, Ron would not recognize a gain, and it would be a taxable gain primarily. So with 351, there's no gain. And if there would be a loss, there'd also be no loss. And by the way, losses also are deferred in this particular situation, for better or worse, under 351. And we'll get to some of the pros and cons of trying to perform a 351 qualifying transaction. There are a lot of benefits. There are some downsides, I suppose, but we'll talk about those as they happen. So in this case, this $100,000 gain that he would have had if he simply sold those assets and then contributed the cash is deferred. And so Ron gets $370,000 in cash, and the firm itself issues $370,000 worth of stock. And again, and then however much the capitalization of the company is worth represents his proportional ownership. And again, he could be a member of a control group that could be, a fairly unlimited number. I do think there's an unwieldiness that comes when you've got people with very, very small property interests. The IRS may disallow the transaction or the tax treatment altogether if you've got people with really, really tiny interests, because then it looks like it's manipulation, and the only thing that's trying to be achieved is to do a tax dodge. And as I mentioned a minute ago, the IRS is always on the alert for instances of taxpayers, whether they're corporations or any individuals trying to get a tax advantage, and simply to do a transaction just for a tax advantage. It's kind of like an individual selling a stock at a loss on December 31st and then buying it back on January the 5th for more or less the same price. That loss would be disallowed simply because the transaction was only to create a deductible loss. And so in that regard, that's an individual example, but it's similar to that, just to kind of give you a bit of an insight into the logic. Okay. So in general, no gain or loss to transfers on transfer of the property in exchange for stock. We'll talk about services here in a second, but if immediately after the transfers are in control of the corporation, then the transaction can apply. When we talk about time frame here, it's a little bit loose, and I think that one could say that the IRS is being probably as flexible as what they can in regard to that. And I'm going to actually pull up part of the text here, because I think this is probably pretty meaningful here. But when we talk about it, hopefully you can see this, if I can maybe blow this up a little bit. This is in your text. This is concept summary 18.1. So if you're not able to see this very well in the video, you can always refer to it in the text itself. Again, any loss is deferred until disposition. So if a gain is realized and it's taxable, then the basis of stock received is equal to the fair market value, which is what we would expect to see happen if it does not meet the 351 tax benefit. If it's tax deferred in this case, we're typically talking about unrealized gains, or gains that would be realized and recognized if this provision didn't exist. If tax deferred, the gains are deferred. Again, deferred, not exempted. Somebody will pay the tax on it, presumably at some point. But then again, that's an indefinite time period. Like a lot of assets, until they're disposed of, there's no gain or loss that's either realized or recognized. And again, nothing can be recognized until it's realized. And so until disposition, there is no realization. Any gain that might be realized here is not recognized, however. And then, but down the road, at some point, a gain, whatever that gain might be, or loss, will be incurred, presumably by the corporation. Okay. Any loss realized if it's taxable, kind of similar here, the loss is recognized. We go back to the same basis of the stock as being that, minus the disposition value. That would create a loss, but if it's tax deferred, it's still deferred under section 351. And what's good for the goose is good for the gander. If you're able to defer gains, then the IRS must allow people to defer losses as well. Okay, so that's essentially what's going on with regard to that. Now let's talk about something that I think is confusing to people, and it has to do with concepts called boot. And boot is a strange word. It's a pretty old-fashioned word, I think. If you go back and you hear somebody say that, like if you buy a riding mower, it's like, here's the riding mower and I'll throw in the grass catcher to boot, right? So it's something extra. Often it's cash, frankly, and it doesn't have to be cash. It could be really anything of value, as long as there's a monetary value that can be reasonably assessed to it, but it's usually cash for the most part. And what it really is this way of sort of equalizing the value of a transaction when these transfers of property are made. Keep in mind, sometimes it kind of goes back to something that we really study early on in economics, and that's the idea of the coincidence of wants. Sometimes it's hard to find in a transaction in which you're exchanging property for other property, which essentially stock is. Are you going to get the exact same dollar value of property you have to exchange in order to arrive at the same net that's coming your direction? So what it really does is sort of plug that difference, and the boot goes back to the shareholder in order to compensate them for the fact that the property value, typically the fair market value of the property value is greater than what is going to be received in terms of the shares that they're going to get in relation to that. So the gain is recognized up to the lesser, whatever the boot amount is, which again is measured in dollar terms, or any realized gain, whichever is less. And we'll show an example here in a minute. And there's no loss that's recognized on this particular type of event. Okay, I'll show you an example here in a minute that does a couple of things. Number one, it really shows really, I think, a very simple illustration of where the boot as an asset comes into play in a particular property transfer, and also it sort of talks about illustrates what the fair market value of the shares are going to be and what the owner's basis in those shares are going to be. And I think it's a really good illustration of what we're trying to achieve here. Okay. All right. Property is broad, as I think I mentioned a minute ago. It can include all kinds of things. It can include intellectual property. It can include real estate. It can include machines and equipment and vehicles and computers and furniture and fixtures and lots of things. We tend to think of these as being fixed assets in nature, but they don't have to be. Certainly something like intellectual property it goes pretty far down on the balance sheet, but that doesn't mean it's a fixed or depreciable sort of thing necessarily, or amortizable even. So it's fairly broad as to what's going on. Installment notes, which are held as an asset, could be exchanged as well as part of the property. In other words, transferring title from the individual shareholder over to the business themselves. And by the way, when we talk about it, we're typically talking about smaller businesses, but not tiny businesses necessarily. I think to establish a control group with a bigger business would be a little bit more complicated. And there are some limitations with regard to that. So, and a lot of this textbook itself does deal not necessarily with the very biggest of businesses, but businesses are mostly have a small business nature. And again, the small business definition itself is quite variable. Even different government agencies have different definitions of what a small business is. And then to compound matters further, the Tax Cut and Jobs Act has its own definition of small business, depending upon which particular thing that's being talked about, which particular code section is being talked about. Okay. When it comes to the stock being transferred, it includes most common and preferred stock. There is a difference. There's an issue there with some preferred stock, and that is what we call non-qualified preferred stock, which really looks more like debt. And what's going on there is really the idea is it really debt as opposed to being a bit of equity. Now, preferred stock is a kind of a tricky little thing anyway, and it's in a lot of ways it's not all that common in many cases. Preferred stock we always sort of view as a hybrid between debt and equity. In fact, the way I kind of view preferred stock is it really has more debt-like attributes anyway, as opposed to preferred stock, or as opposed to common stock. Typically doesn't have voting rights. There may be some conversion privileges where you can convert preferred stock to common, but typically preferred stock is non-voting stock. Typically pays a rate of return that's specified and whatnot. But in a lot of ways, though, preferred is already sort of that. But if it has attributes of debt, then the IRS may not consider that to be exchange of stock. And remember, we've got to have an exchange of value, a fair market value for fair market value. It does not include stock rights and stock warrants. And the difference between stock rights and stock warrants are very similar. The main difference is timing and who receives these. Stock rights tend to be issued to existing shareholders. These are typically publicly traded companies in this regard, and they expire usually fairly quickly within a few weeks. Stock warrants may have a much longer time frame. And they're basically rights to purchase stock. Okay, they're not like options in the sense that options have a definite expiration date, and options can be publicly traded or can be doled out, oftentimes to individuals, but stock warrants, again, can also may have much longer maturities. It also doesn't include any kind of corporate debt or securities, any kind of corporate bonds that are involved in the transaction. Those do not qualify as stock being transferred. In other words, that would be treated as boot, just like cash if you're treating debt. So it's what they want to do is the provision is to exchange stock for property coming in to the corporation. So that's essentially what the goal is there. And then I talked a bit about this a second ago, and it's the issue of control and this idea of being in control immediately after the exchange in order to qualify for the taxable treatment. Now, immediately, I know that this is sometimes misconstrued and misunderstood, because I think sometimes the way, if you're just reading this on its own without any sort of additional discussion, you might think, well, it's all got to take place in the same day. And it does not, but it's got to be in a reasonable time frame. And what is reasonable? Well, it depends. And that's an accountant's answer for sure. But several weeks sometimes might be practical. Keep in mind, these shareholders who are transferring property may not even be in the same city, state, in the same country necessarily. So getting them all together is not a requirement, and there will be some time to qualify for this. And also, if you're transferring something like real estate, this is not a simple transaction. I mean, you're transferring title, and there are a number of different steps and other parties that are involved in that. And so, to time all this perfectly would be quite complicated. And so there is a little bit of a leeway. However, if we're talking years, that's probably not going to qualify. And that's an issue. Okay. And at the time this control is established, at least 80% of the total combined voting power. And again, this is why preferred shares are not included typically. The most preferred shares do not have voting power. So immediately preferred shares are already subject, but total combined voting power of all classes are entitled to vote. And the total number of shares outstanding are in the hands of the control group. And there are some issues in which this can be transferred to somebody as part of a gift or whatever, but as long as the purpose is not simply to avoid taxes, then this is fine. And in this regard, control immediately after the transfer does not necessarily require, again, simultaneous transfers. And one thing that I think is interesting is, in order to avoid any confusion and maybe even to support one's case for the 351 treatment, is that maybe some sort of written agreement or some plan, something that's laid out as an organized action plan for performing this would I think help. And again, the transfer should occur as closely together as possible. Again, same day is not reasonable, but close enough together would make that make sense. And I would think that probably doing this across tax years might complicate things. And so I would say, if you're going to do it, maybe do it sometime and not have this whole thing carry over from one accounting period to the other. That's just a complicating factor. And but again, we could bring up all kinds of crazy scenarios, and perhaps we don't want to do that. So also, it's not necessarily lost if the stock is sold or given to somebody who are not parties to the exchange. I think the text had one of the examples was giving some shares to one's child or whatnot, and so that could make sense. Okay. All right. So so that's essentially what's going on with regard to the establishment of the control group, and shareholders become part of that group as by virtue of their transferring property into it. Okay. And transfers here may result in the service provider being treated as a member of the control group and taxed on the value of stock issued for services. Okay, let's talk a bit about services here, because services are a little bit different. And again, the stock being transferred has to meet the 80% test, but the service provider should transfer property that's got more than a relatively small value. And what that means is sometimes people will provide services in exchange for stock, and also or stock and property together. The issue with services, though, is one that I think is very rational and easy to understand. Services typically are not exempt from transferring for a lot of reasons. Number one, if you're providing services, and you're being compensated for that, well, that's really a form of payment, it's income. Again, we are talking about income taxes, and so in most cases, you cannot get away with providing a service and being compensated and have that escape tax. That's a difficult thing to do. The other thing is that how do you establish a basis with regard to a service? It's one thing for me to say I'm going to transfer an 18-wheeler to this corporation, and we can the basis is known, presumably. Fair market value is presumably known. So it's the basis that's the issue. How do I know what the basis of things are? I mean, I work for CNN. Can I say that they pay me $20,000 greater than what my basis and my services are? It's just an impossible and unworkable situation. So services are a little bit of a different situation, and we'll talk about that in a second. Okay. So we have a number of knowledge checks. They're just simply little quick quizzes that we see throughout the slide package. And as I mentioned in the first segments video, I do cut out some of these, particularly some of the examples and whatnot, just in order to save some time. Obviously, you've got access to the entire PowerPoint package. All I'm trying to do is give a little bit of context, maybe a little bit of background, hopefully try to explain some things that I think are in need of some elaboration. Okay. Oh, and again, the 10% rule is and by the way, the 10% rule is this comes up a lot in accounting, and including tax accounting. And when we talk about services and property being transferred, the 10% rule for the value of property in relation to the value of services applies for the purposes of establishing control. Remember, we're trying to 10% at least of property value if they are trying to contribute some property, not just services. You can receive cash for stock for services, but there's no basis of that necessarily if that's all that's being transferred. All right. So the quick knowledge check here: which of the following is to be included as a stock for the non-recognition of gain by the shareholder? Okay, so which is, and it's going to be the answer is going to be C, preferred stock. The non-recognition of gain occurs only when the shareholder receives stock. Stock includes common and most preferred shares. And so of those, that would be the one that would work. The others would not. Remember, stock warrants, corporate bonds, stock rights and warrants, neither one apply, and non-qualified preferred stock does not. But preferred stock in and of itself, even though it is a bit problematic, as I mentioned, but it's not specifically excluded from that transfer and from the tax treatment. Okay. All right. Now this is a pretty generic, obviously no dollar figures description of what's going on with regard to the basis determination, particularly in terms of the adjusted basis of property transferred, whether there's any gain recognized, whether there's any boot received, whether there's any adjustment for any property loss. None of these may apply at all. It could be the adjusted basis of the property transfer equals exactly the basis of the stock received. And so, and if that's the case, that's pretty simple. And in that regard, if we can get to that situation, which is not all that uncommon, frankly, then it's all to the good. What I want to do is I want to show you, I mentioned a minute ago that there's an example that I think is pretty good. And it does, as I mentioned, it does a couple of things. Number one, it talks about the discussion about the taxability of the boot, which one shareholder has received, and therefore the basis is lowered as a result of that. So in this case, this is in your text. It's in example 16. And I don't have the page numbers, but you can simply find it in chapter 18. So Keisha and Ned formed Brown Corporation. Keisha transfers land with a basis of $30,000 and fair market value of $70,000. Okay, so she has appreciated property she's donating, or I keep saying donating, it's contributing. Ned invests cash of $60,000, which his situation is quite easy, but hers is a little bit trickier, but not too bad. They each receive 50 shares worth $60,000, but because she's contributing, Keisha's contributing property with $70,000, $10,000 is sort of, I guess, rebated back to her. I mean, whatever the land is, what are you going to do? Parcel the land off and cut off a 1/15 of an acre or something? I mean, it's just not practical to do that. So as a result, in order to equalize the transaction, to make it a fair, arm's length transaction, some boot goes back as sort of a rebate of the excess of the fair market value over the basis of the fair market value of the stock that she's going to receive. So in this case, let's take a look at what's going on here. Now, Keisha's gain is still, remember, she still has a gain, but it's deferred, okay? So despite the taxability of the boot she received, the gain that she has, that 40,000 gains, is still in all cases really, that particular part is still deferred. But her basis is lower. So let's take a look at what's going on. So the basis of the property she's transferring is 30,000. Remember, her basis, your basis really never changes, does it? And even though the fair market value line. So, and she gets 60,000 stock. And again, the boot that comes her way is in order to equalize the transaction. So what is the gain? Well, it's simply, it's going to be a $40,000 gain. 70,000 minus 30,000 is 40,000. She has to pay tax on the 10,000. There's no way around that. That's really partial compensation for some of the property she's contributing. Remember, any kind of boot, any kind of property that is sort of rebated back to the shareholder becomes taxable, and so as a result, her basis is lower. Now, why is her basis lower? Well, think about this. This is really important. It's important because remember, she's got a deferred gain, and that which is now being transferred to the corporation, but it also lowers her basis as well. Okay. If you're going to get a tax benefit, which she is going to do, then it lowers the actual basis or interest in the asset which is coming your way. Okay. So if she disposes of the stock at some point, presuming that the fair market value of the stock still exceeds her basis, and she will have a gain at that point. And who knows what that will be, or a loss if that should be the case as well. But her basis is reduced because of that, because she does have this immediate tax benefit coming in her direction. This is important, and it goes to the idea, and it's just a truism of tax accounting, is that it's better to have a higher basis in assets than a lower basis. So a lower basis, and this comes up again and again in this discussion, a lower basis is a more unfavorable tax situation, mostly because a lower basis means you'll have a bigger gain at some point or a smaller loss at some point. And at some point means at disposition, whenever the case might be. Okay. All right. So that's her situation. Ned's basis is 60,000. This is not complicated at all, right? He contributed $60,000 in cash, got 60,000 cash received. There is no gain. Well, there's no gain or loss at all going on here, and so his basis becomes this. The basis is what he's got there. This is not particularly complicated at all, and in fact, there's nothing being appreciated. So he really has no. It doesn't really necessarily apply in his case. The big issue here, though, for this to work in Keisha's case, is the control group has to own over 80% of the shares, and I believe that these are the only two owners in this, and so as a result, this would defer her gain that she would have by transferring that over. Now we'll get to a little bit later some examples in which somebody may want to sell the asset, get the cash, then invest it, and we'll talk about why somebody might want to do that. And that sounds like, you know, maybe foregoing an opportunity to defer some gains, which most people in general would claim to be good, but everyone's situation is a little bit different. This is why blanket statements of always are oftentimes not particularly applicable when it comes to tax accounting, just because situations are different and there are all other kind of considerations. And this is why, as I mentioned at the outset, that a lot of times people will consult tax advisors when doing a lot of things that are of a complicated nature. All right. I also want to go to concept summary 18.2. This is again, this is obviously sometime further back from 18.1. I think it's about 3 or 4 pages a bit later. And we'll look at this with 351 treatment and without 351 treatment. In this case, we had with 351 treatment, she does have a $10,000 boot, and it becomes taxable. And so as a result, she will pay tax on that. If we didn't have 351 treatment, that 40,000, that's the difference between 70,000 and 30,000. In other words, fair market value of the land minus the basis of the land would become taxable, and so that would be an issue. But her basis would go up. Okay, her basis would go up because there's no deferral. It gets all claimed at that time. So this is the thing to realize, is that when you get this particular treatment, remember, you're transferring basis in the assets to the company that's receiving those. And as a result, you're getting stock in return, but you can't have it both ways. You either take the lower basis and defer the gain on the assets you're transferring, or you don't take the tax deferment and you pay the tax now if you're going to do without 351 treatment. And there could be reasons why we would not want to do it. And it just really depends upon what is necessarily going on. Notice also what I like about this one, I point out, is that this is the shareholder point of view. And this is Keisha's situation, because obviously the other guy, whatever his name is, I forget, is quite easy. But here's the company itself. There's no gain or loss recognized on the transfer of the stock for the property. And the reason why is very simple. The company does not own itself. The company is owned by shareholders. And so as a result, there's no basis in the stock itself. We'll see a little bit later that this is particularly valuable when it comes to things like treasury stock transactions, which have become very popular in recent years, extremely popular. It's kind of slowed down a little bit, but for a while there, particularly as companies were swimming in cash and the stock market was quite low, particularly during the COVID years, we saw just a lot of that activity going on. But anyway, the company does not own itself in this regard. The property basis is going to carry over from Keisha to the corporation itself. And without 351, there's no gain or loss. And the basis of the assets are going to be 70,000. The difference in her basis and the company's basis again will equal 70,000, which is the fair market value of the asset being transferred. So that's how we account for all the dollars involved in the transaction itself. Okay. So hopefully those examples are somewhat helpful. And again, there's some more. If this is some information here, particularly if there are losses involved, and in this case, we don't have any of that happening. Okay. All right. So I want to talk a little about when there are liabilities that are assumed. And I'm kind of going at this without taking some breaks. And the good news for you is that watching the video, you can stop whenever you want, or back up, or whatever. And if I'm mumbling, which I have been told I do, then yeah, I'm sorry. You can back up and maybe catch what I've been talking about. But I do want to kind of go on, since we're not live. I can't take questions, but again, I am always available to answer questions. So let's talk about this idea of the corporation's basis in the assets that are coming their way. We talked a bit about from the standpoint of the shareholders. Let's now we just started talking about what is the basis in the assets coming their way, not the stock, because they don't own themselves, but they own the assets now, which are being transferred to the company. So in this case, we have an example with three different examples of where liabilities are involved. Now, keep in mind, we're talking about liabilities that are being transferred to the company from shareholders. Remember, these are not assets. These are not money that are owed to somebody. It's not someone else's liability. It's the shareholder's liability owed to someone, and they can be transferred over. And we'll talk about what this does to the basis of the assets as they're being transferred. So in this case, fairly simple scenario. We have three different issues involving liabilities. Fair market value of the assets 150, basis 100. So the realized gain is 50,000. That may not be recognized. Depending on what we're going to do here. So in this case, we're going to say that, and we mentioned that these are independent facts. So this doesn't happen, then this, then this. These are all independent and mutually exclusive situations. So in the first situation, the assets being transferred, and we make it, the textbook authors make it a point of saying this is for a business purpose. Now, let's talk a bit about this, because this may not be completely clear, but this goes back to one of the things that comes up again and again, is that a business has to be a true business in order to receive whatever kind of tax benefits that might accrue to being a business. And there are all kinds of instances in which the IRS says, hey, the only reason we formed this business was just in order to dodge taxes, or to maybe take a capital gain and convert it to an ordinary gain or a loss, whatever the case might be. And we don't believe that you're a real business. And that is actually not that infrequent of a judgment. And you know, this idea of trying to establish a business just for the purpose of dodging taxes is frowned upon, and when caught, I hate to put it that way, but when caught, oftentimes there's a disallowing of whatever benefit comes their way. So in this case, all right, there is a business purpose, and business purpose one, a liability of $80,000. And so what's going on is this: the liability transfers over the basis of the assets. Remember, we're transferring basis, $100,000 of the assets here, and there's no gain recognized by the shareholder. We're assuming this does qualify for 351 treatment. Okay. All right, now it's a little bit different when it comes to business purpose number two, because the liabilities are greater. The liabilities actually exceed the basis of the transferred assets. Now, there's a gain recognized by the shareholder, and why would that be the case? Because of the fact, think about what is going on here. When you have a liability that goes away, which is what's happening if you're a shareholder, you get a tax benefit. Now, some of that benefit is mitigated by the basis, not exemption, but the taxation of this basis, this deferral of taxation on the basis that's transferred, but not all of it, because you've got a liability, you got a tax benefit that is greater, the liability you're giving up is greater than the basis of the assets which are actually transferring. So in this case, the gain is recognized by the shareholder. In other words, in this tax bill is $20,000. The thing to think about, the way I would sort of view this, particularly for those of you who have worked in accounting before, in tax accounting, or taken tax one, is any kind of liability that goes away. And we think of this a lot when somebody is unable to pay a debt and it's charged off. It's charged off as a loss, and the creditor will then send a 1099-C to the debtor, and it becomes taxable. And I know and I have had many clients over the years who have gotten this and said, "What is this?" And I said, "Well, it's the taxable amount you've got to pay on the debt, and for whatever reason it was not paid." And of course, to them it's like a double whammy. Hey, I couldn't pay the debt in the first place. Now I'm going to pay tax on the debt that I couldn't pay. And the answer is yes. That's the way the tax code is. A very similar situation here, but it's not. There's no bad debt situation. We're not implying that. I'm simply saying that you're removing a liability from some party, and only part of that can be you would have gotten this benefit anyway, even had this been, this amount or lower, but you do have to pay tax on that particular thing. But your basis goes up as a result of that, because whatever you pay tax on, becomes after tax, and you establish a basis in that. It's kind of like making a contribution to an IRA that's where you've already paid tax on the money. Like to a Roth IRA, for instance, you've got a basis in that, or what is sometimes the case is somebody has a basis in a contribution to a traditional IRA. It's not common. Most people want to defer the entire contribution, but sometimes people make an over contribution, and that amount becomes part of the basis, and it certainly is not eligible for deferral in that particular accounting period. But there are sometimes cases in which there is basis in a traditional IRA. Same kind of idea there. Then the final was no business purpose. And when there's no business purpose, what's going on is the basis is the entire amount, fair market value of the property being transferred. The basis still remains the same. And the gain to the shareholder is simply that amount, that difference between fair market value and basis. What's going on there, and why that's the case, is because if it is established that there is not a business purpose, that the purpose of forming this corporation is to create a tax dodge, then the matter becomes simply a case of where, well, you've got to pay the tax on that, because remember, you already have a basis. You're not going to pay the tax on basis twice, but you're going to pay difference on the tax on the difference between the fair market value and the basis, which is $50,000. Okay, if that's considered to be the case. And when we talk about this issue of non-business purpose, we're going to actually come back to this a bit later and talk about, particularly as we get into issues of different types of business structure and all that, and some of that will come up a bit later, and also different tax treatment regarding different entities. But that will be something we'll come back to a bit later. Okay, and then again with independent facts here, basis of assets being transferred. You got here, this is the basis in the stock. This goes the other direction. The basis in the stock is 20,000 because of the fact that remember the basis of the corporation, the assets is 100,000. The transferring basis over the basis in the stock is reduced by the $80,000, and so as a result, the person's basis goes down. Remember, the basis is being transferred, and you are exchanging $80,000 of tax benefit. But now you have a lower basis in the stock that's coming your way, you as a shareholder. And remember, if you have a lower basis, that's a disadvantageous condition as opposed to a higher basis. Presumably, this person will have either a larger gains tax to pay or a smaller loss to deduct at some point in the future because of the lower basis. I can't think of any case in which having a lower basis is better than having a higher basis. I suppose somebody could point something out that's wrong, but for the most part, I think that's a general rule of thumb. In the case of the basis in stock to the shareholders here, the basis is going to be zero, mostly because of the fact that for the reasons we talked about, they've got a bigger gain coming their way than the basis of the assets being transferred, and they do have to already pay tax on this. And so the basis of the stock is actually zero, which means they have an even lower basis because they have an even bigger liability they were exchanging. So that would make sense. You have a bigger amount of liability you're exchanging, you're pushing off onto a business, which is not all that unusual. It's a little bit tricky at times because presumably there's a third party who holds a note or some obligation, and they may not be keen to have somebody else now be paying it. But for the person who's transferring it, they're getting a benefit. They're getting rid of that debt. That is no longer their debt, presumably. And to the extent that that can happen, that makes a lot of sense. Now, it could be that in reality that the corporation will actually refinance the debt in their own name at some point soon, which takes even a legal obligation to pay away from the shareholder altogether. And but again, it's the same situation regarding the basis, which goes down to that extent. Okay, and then again, in this case, you do have the same amount of liability being transferred. There is no deferral of gain here at all, but you've got an increase in the basis of the stock because you are paying an amount of tax. $30,000 is taxable, and so as a result, that becomes basis. Okay, because it becomes taxable to that party if it's considered to have no business purpose. And I think you probably don't want that eventuality to happen. Okay, let's move on to talking a bit about basis for lost property. I'm not going to talk a lot about this, and the text does not get into this a tremendous amount. The issues are a little bit tricky, and but the idea is that when somebody is contributing built-in lost property, that basis has to be stepped down to where the basis then is actually less than what the fair market value of the property is. This is what built-in lost property is. This is when, for whatever reason, the value of the property is worth less than its basis. And it does happen for all kinds of reasons. Maybe the asset itself is obsolete, or it's not up to standards. Maybe there's some impairment with it. Who knows, what it is. And in this case, you have to reduce the basis simply by the amount of the difference there. And it's really done in order to prevent parties from getting a double tax benefit. And we see this logic in the tax code again and again, that in very few cases do taxpayers, whatever the kind of form of taxpayer, it's very rare that they get a double tax benefit. One of the only times I can really think of that happening is for people who might qualify, this is an individual return, for an IRA deduction, like an IRA contribution, and also get the retirement savings contribution credit. That's a double tax benefit. I guess you could argue that the child tax credit might be a double tax benefit if having your child qualifies one for the child tax credit as well as the earned income credit. It's probably not the best example, but what I'm simply saying is that very rarely do you have multiple tax benefits accruing in your direction, particularly within the federal return itself. Now, sometimes these benefits are replicated over state returns as well, but we, again, as I mentioned in chapter 17, we're not getting into state taxes, state income taxes at all here. Okay, so the step down is allocated among those, and if both of them elect, the basis can be done either to the shareholder or the corporation, but not both. Someone's got to take this step down in basis. Remember, a step down in basis, a lower basis is less advantageous than a higher basis. And so one can do it or the other, but it's got to be by agreement of the company if election is made along those lines. Okay. Okay, let's talk a bit about services. And I mentioned we're going to come back to that and talk a bit about services and how they work here. And that is the idea that corporations may be able to deduct fair market value of the stock issued in exchange as a business expense, like management services. And the reason that they will do this is because it's really more of it's more compensation, like a wage, really. Is really what's going on. So, however, if they're treated as a capital expenditure, and of course the classic case here will be legal services that are considered organization costs, remember, and this even applies in GAAP accounting, that organization expenses typically are capitalized and then amortized in this case over time, but in which case you cannot immediately expense them. And so that's, something to consider there. That would be one exception to the treatment of services when it comes to services in exchange for stock. And I think your text had an example going out of a business startup in which there was an exchange of services as opposed to simply an exchange of stock. Okay, I just want to make sure everything is still rolling. I hope I don't run out of time, because I think I set this for an hour and a half, and I think I got a little bit later start, so hopefully we won't run out of time. I'll do my best not to have that happen. And so let's talk about holding period. And when we talk about the holding period of the property that's being transferred, when does that holding period begin? Holding period basically says when I had started owning this asset, and then eventually down the road when I can dispose of it. And presumably we're talking about capital gains treatment. Do I get capital gains, long-term gains treatment, as opposed to short-term gains treatment? And again, 1231 property we mentioned last time it's mostly considered fixed assets for the most part, with some exceptions. And so 1231 property tends to be capital in nature, and even though it's for business purpose, and for the property, not capital assets, it's not the date of that, but rather the date after. And that's just the way the law is set up in that regard. Okay, and so that's basically what's going on there. And let's talk a bit about recapture. And let's talk about what recapture is. Recapture is anytime the IRS recovers some tax benefit previously granted to a taxpayer for whatever reason. And the recapture possibility here transfers from the transferor, which is the transferor, I should say, which is the shareholder, to the transferee, which is the corporation. And remember, these assets are being transferred, not only is legal ownership being transferred, but also their tax attributes are being transferred. So a corporation might therefore receive any of the benefits from capital gains treatment upon disposition, whenever that might happen. So what happens is you're transferring not only the asset of your shareholder, but you're also transferring those attributes as well, and any recapture. And classic case of recapture is when you've got a depreciable asset, and in other words, you're taking tax benefit year after year, like a building or whatever. You're depreciating over many, many years, and suddenly you sell it. And so any kind of a gain is essentially a form of recapture in that regard. Okay. All right. So moving along here again, I'm hoping I don't run out of time here. Quick question on the knowledge check activity. It basically asks, when determining the basis of stock for a property 351 transaction, what is the correct answer? Is fair market value of the property the day the transfer is used? Any recognized gain reduces the basis? Any boot received reduces the basis? Any liabilities transferred increases the basis? Any cash received increases the basis? And most of these are wrong, and so the answer has got to be D. The liabilities are reduced by the basis of the shareholder's stock. Okay. All right. Let me see here. Did I skip over some? Oh, I'm sorry. It's any. Oh, you know what? I went the wrong. It's any boot. Yeah, I suppose I thought it was C. When I was looking at it, was any boot. I checked the wrong answer. I think we clicked down here. Any boot reduces the basis. By definition, the boot reduces the basis. Simply because of the fact it's you're not transferring that property. That property is coming back to you. So it would obviously be a reduction in the basis. Okay. So the shareholder's basis is exchange is determined as follows: adjusted basis plus any gain recognized minus boot received and any liabilities transferred, which we talked about a second ago. Okay. All right. So let's talk a bit about assumption of liabilities here and what's going on. So when a company is assuming liabilities in a 351 transaction, it does not result in a boot transaction, because the transfer of the liability removes the burden from the transferor. So reducing one's basis in assets becomes an unfavorable tax situation to the shareholder generally, and so as a result, it's already not. So there's no double tax detriment, but in this particular case, it does not result in boot to them. The liabilities are treated as boot for determining basis in any acquired stock. The basis of the stock is reduced by the amount of the liabilities that are transferred. Okay. All right. Then also, liabilities are also not treated as moot for gain recognition unless the liabilities are incurred for no business purpose or as a tax avoidance mechanism, which may be in fact the same thing. And that is, you know, you're not going to be treating there's no real benefit from, you know, doing a transaction for as a 351 transaction when in fact there's no business purpose that is going on. Now, when the liabilities are greater than the basis of the assets being transferred, which we saw in one example there with $120,000 versus the $100,000, then there's a gain that's recognized, and the difference in that is the excess of the liabilities over the basis in the assets which are being transferred. That was the one example. I think it was example 2 that we just saw a second ago. Okay. Alrighty. Okay, and let me see. I think I brought something to get rid of that. So when we talk about we just talked about assumption of liabilities, and this is an example of this, and this is very similar to what we saw before with the same scenario and the same transfer of things coming over. But in this case, though, we're essentially talking about what is the fair market value of the stock that's received, and in this case, all the same facts apply. Here we're talking about what the issue is with regard to gain recognition, and fair market value of the stock that's being received is 70,000. The liabilities are assumed are 80,000, and that is let me see. I keep doing this. I keep flipping around here and missing my mark. And hold on just a second. Hold on just a minute here. Shoot. Okay, I've refound my place there. Apologize for that. Sometimes these PowerPoint slides don't always work like I hope they do. So in this case, we're talking about the fair market value of the stock that's received. For the business purpose 1, this fair market value is 70,000 because the liabilities are assumed are 80,000. In order to get to the 150, which is the fair market value of the property that's being exchanged, and again, the basis of the property is 50,000. So there is a gain that's being recognized there simply because of the fact that the fair market value is greater than the amount of the basis. And the same goes across here. Now notice in non-business purpose, we have the same gain all the way across here. And so that's simply the result of this difference here between liabilities and when they differ from the amount of the fair market value that's being transferred. Okay. All right, so let's do this. I'm going to skip this knowledge check here and go into the capital structure of the company. And then after that, I think we have we have 2 more sections actually. So I want to kind of get to capital structure and talk a little bit about what's going on here. And when we talk about capital structure, there's no gain or loss recognized by the company for receipt of any money or property exchange for stock. And I mean, because it wouldn't really make sense. Presumably, the company would not issue a greater amount of shares in terms of value than what the or less even than what the fair market value of the property would be. Again, we're assuming this is again an arm's length transaction, even though people may all know each other and be friends and all that good stuff. It really wouldn't make a lot of sense. And so, any kind of property that's donated or contributed in this case, no additional shares are issued in this particular case. So, contributions by non-shareholders. This is really, I think, an interesting part of this, and this has to do with something we see frequently. That is, particularly companies are looking to expand or to set up a new operation somewhere, and a government entity in particular. I don't know. I can't say civic groups are all just much involved in it, but certainly government entities to do things like include property. What are we talking about? The locality may build a road. They may install water and sewer. They may install power lines and fiber optic, and they may grade the road. They may create zoning opportunities. All this is included in the corporation's gross income, even though it's why wouldn't it be? I mean, it's a contribution of property, and it's an inducement, obviously, for companies to move to a location and hire people. And oftentimes there are a lot of terms involved with this, that they agree to employ X number of people for X period of time. And so as a result, it's a fair shake in this regard. And But if a company grants a tax abatement, then the tax abatement is not taxable. And this becomes really a local issue. And so the IRS is really not involved in that because tax abatement primarily is a local issue. And so this is really disregarded. And it relates to any kind of state tax and or local tax. Some states have local tax as well, some do not. We do not, obviously, here in New Mexico, but there are some states that have state taxes and contributions by non-shareholders. If we're talking about like contributions primarily by